Hello. Continuing with our market state analysis on the S&P. So we had a Labor Day holiday weekend coming in on Sunday night, and the S&P is again still in a bear trend. And the structure of the market is the sentiment structure is at the upside pivot at 1943.5. So that is the high point of any bear trend kind of corrective action. We would expect it to top out there if the bear trend is going to continue. We still have some fall through potential, but it is a holiday trade, and so our strategies are to fade momentum into that R level and accept a reversal signal if we get it, or we have our hedge strategies that we've seen before where we have a downside pivot reversal, DP reversal, and we have an R level breakout to the upside. So here's where we left off on Friday, and the market was trading in that big downtrend, and we closed underneath the downside pivot. And so if we start to move forward in time, Sunday evening the market comes up and challenges the upside pivot. This is the top of the bear trend. So we're coming into fading into this 1943.5 level. Early morning Monday we get another retest, so we kind of had an exhaustive signal here, and then this gave us a half APMD, another half APMD into another fade, and the market rejected with another half APMD. And in some kind of typical holiday trading, just kind of messy, but sticking with the bigger picture, sticking with the big bear trend picture. So let me pull this over here. So we had, here's our action on the 3rd that gave us the nice entry with the fade and the reversal, kept with a big negative downtrend the whole way. Coming into a holiday weekend, we get the break-in structure. That break-in structure here confirmed this corrective move, and that corrective move came back up to the R level, which is the peak of the bear trend market state, and now we're coming off that with lower move highs, lower move lows. So the key right now is to get underneath this 1924.25 directional area. Watching how the market moves through the structure, understand we're in this bear trend, using the structure bias as a key flip number for that momentum, and we've seen the sentiment bias shift from upside pivot to directional, kind of pressing it lower to shifting back up, and that shift back up can sometimes be a tell that you can see these kind of corrective moves. This happens a lot when the R level shifts way above the market. It's a tell that this is where the energy at, this is where the real sellers are, the real market participants are going to make decisions here. This is where liquidity is. And the market likes to go into that liquidity and test it, and it did. So as we come into September 8th, S&Ps are still in the bear trend. So we're still in negative trend, lower move lows, lower move highs, that's the expectation. Negative bias. And our structure, we have the same structure where we have the R level at the upside pivot. We have the directional shifting up along with the upside pivot shifting up. So we know we've been in this corrective rally of a bear trend. We know now that that peak is at 1947.5, and we know that for the bear trend to resume, it's going to need to fail below 1928.5. So as we move forward, overnight we see the market break structure. So here going above the R level, we're breaking out to the upside, and then here we get a confirmation of that break-in structure where the market takes out the CRX plus and goes above the 57 level. So this is a tell, and as we look at the S&P, here's our structure point, and we've broken this structure. So the market is no longer in a lower move low, lower move high structure. It's changed. It's in transition. It's doing something else. So now we have to adjust our tactics. So always going back to the fact focus. We know that the bear trend structure has been broken. There's no more optimal strategy. The market's not in a bear trend anymore. We're in a hedge strategy theme. So right now we're in this theme. The market confirmed a breakout above the 1957 level, and now the market is in transition. And if it's going to be aggressive, it should build structure above this 1947.5 level. Now this weakness can come all the way down to 1928.5, and this hedge theme is still valid. If we break under 1928.5, this hedge theme is not valid. And so then the market has broken structure for both the optimal and the hedge theme, and we would expect this market to have more of a sideways non-event day. So this hedge theme is our buy R breakout. And so any breakout strategy, we're going to anticipate that this market is going to build positive structure. The thing about transitional trades is that we're not sure what we're transitioning into. Is this a bear trend correction move? Is this a positive signal into more of a neutral state? Is this a positive signal that's going to transition us into more of a bull trend state? We're not sure. And so how the market behaves on this breakout is key. And that's the tell to what it wants to do. So here's a clean chart. So we have our 1928.5 directional. This was the confirmation point to the downside for the bear trend to resume. This momentum. We had a break-in structure here, and we had a confirmation of that breakout here above the 1957 CRX Plus. One benefit of the S&P, it's a stock index, and with the stock indexes we have some other markets of Confluence that we can look at. So we've got the NASDAQ, the Dow, the Russell. We can also look at the European stocks, which are open at the same time, to see if they're having some influence, or they're participating the same way, or their structure is being broken as well. So it can give us confidence. A lot of times in the indices, they all like to move together. So if the S&Ps are breaking structure, are the other indices breaking structure? They're all in bear trends, and the S&Ps are telling us they're breaking structure. So let's take a look at the NASDAQ. NASDAQ's a bear trend. Its structure is identical to the S&P, and you can also see that on the grid. We have the R level here on the grid. So you've got the general type state, the signature state, tag, and then the R level position. In both the S&P, NASDAQ, the Dow, the Russell, they're all teed up in the same state and structure. So all the strategy themes are identical. Same with the Euro stock, same with the FTSE. The DAX is a little different, where the DAX, the structure is at the directional. So it's a little more aggressive. That's that bear trend. It really has to stay hard pressed, or it's vulnerable to a corrective move. So here we have the NASDAQ. It's in a bear trend. We've got our structure point, and we have the market overnight holding above its directional, and then breaking out above the upside pivot R level and confirming a break in structure. So at this point, the bear trend is no longer true for the NASDAQ, and then it pulls back and gives us a reaction off the upside pivot to confirm that we are indeed in a hedge strategy theme. So we're in this theme for the NASDAQ. So the NASDAQ has broken structure as well, and it has a nice structure point at 42.53. This is going to remain a good buy zone down in this area for the NASDAQ. So what's the Dow look like? Take a look at the Dow. Dow's in a bear trend, and it has its structure at the upside pivot as well. So it is in an identical strategy situation. Here's our directional, upside pivot, breakout, confirmation, and stabilizing above the upside pivot R level. So let's take a look at the Euro stocks. So they are in a bear trend, same structure, same state, and we have the market starting out above its directional, breaking structure at the 32.38 upside pivot Rs, confirming that above the CRX Plus, and the Euro stocks have attained their initial targets. They attained the initial target at 32.78, and they fell just shy of the upside pivot on this retracement. So this is interesting that Europe attained its initial target, and a lot of times, when we're climbing the ladder of the price map, once we hit this rung, it is natural for it to have a reaction back down to the upside pivot before it makes a decision, yes, we are going to continue with this transition. If this target had not been attained, there's still more energy in this current rally and could continue to ramp up. But the fact that we rejected here and we're back here and did this is a sign that maybe we're in for more of this action. Again, the bear trend is no longer valid, and now we're in a hedge strategy, and these strategies aren't as clear. And at this moment, they broke this aggressive buying. So are we just going to fall back into kind of a difficult sideways digest? We're not sure. So let's take a look at the DAX. So the DAX had a little different structure point where the R level is at the directional, so a little more aggressive. And so it's going to turn quicker. And so let's take a look at that, and it did. The DAX right off the get-go made a decision off the R level and didn't look back. So the DAX was really the leader in this break-in structure, and it actually attained 2 full APMDs off this move. So this is what you're looking for ideally for any breakout or trend move, that you're going to get 2 full APMDs. So the DAX gave us that right off the get-go, and this is textbook. And again, this is what you're anticipating, is just holding positive structure, not looking back. It's a correct. You're in a bear trend. You had a break in structure, and bear trends like to correct with aggressive rallies. This is just all part of the state and structure. When they performed expectation or the optimal strategy, they do this. When they transition, they tend to do this. A rise above the R level is a sign of strength that has the potential to be the spark for a positive transition. Don't fight positive structure above the R level, and avoid any sales above the upside pivot, as the potential for a one-way railroad rally is real. And that's what we had. We had a textbook move that played out. So this is interesting as well, because the DAX is maybe done. And if that has been the leader, if that was the leader of this positive transition, this positive break in structure of all the bear trends, of all the stock markets, then the DAX led, and it attained its target. This may be a tell that we're in for maybe a corrective move in the DAX, and if that was the leader, maybe that's going to signal a corrective move in the other indices as well. So always looking for confluence, especially if you're trading the indices, or if you're trading the interest rates, looking for other interest rates, what's happening, currencies or crosses. It's always nice to have other markets of confluence that you can look for to give you insight to the market that you're trading. Along with looking at other markets of confluence like the NASDAQ, here's the S&P, here's the NASDAQ. We can also take a look at what the interest rates are doing. So here's the Treasury bond, and we can see that the Treasury bonds have been in a pretty good negative trend all day, all overnight, and that's kind of been the opposite for the S&P. So it's nice to see some confluence there with the interest rates. And then we can also look at crude oil, where you had a big rally in crude oil all night, and then you had a reaction off its upside pivot R level down to its directional. And so you can see some similarities in the action in the S&P, where we had a little bit of a sell-off, and maybe that was due to the weakness in the interest rates as well as the break in the crude oil. Taking a look at the market state for crude oil. Crude oil is in a neutral digestion, and its structure bias is above the market at the upside pivot. So this market's wound up in a digestive trade, and R level is going to be key, where we're either expecting a reaction, which we already had in the crude, or on a hedge we get a breakout and it's a buy signal. So this market's wound up, and it could have some influence on the equity market today. Bond market's also in neutral, but it's wound up, but its structure bias is below the market at the downside pivot. So if it doesn't hold this level, which it did not, we're currently in this hedge theme right now in the interest rate market. So we might be transitioning in the interest rate market to the downside and that would bring back kind of that natural inverse relationship with the equities. So you've got a breakout to the upside in the S&P, where we're in this theme at the moment, and you've got the treasuries that are in this theme. So you've got some nice confluence there as well. So moving forward, we have the S&P stabilizing off the UPR level, and we have the same action going on here in the NASDAQ. So this action in the NASDAQ can give us a little more confidence with this stabilization here in the S&P. Interest rates, the 30 years continued to stay on edge, so you've got this downside negative hedge theme going out in the treasuries, and crude oil is breaking out to the upside above its upside pivot R. So you had the test for the fade R, and the directional is always the key structure point whenever we have if we're going to have a shift in momentum, that it's going to be told at the directional, and here the directional stabilized this weakness and kind of put the crude oil back in line with this positive momentum, and now we've broken out. We did not confirm the breakout. The market did not go above the 46.43 CRX plus. That would, that's the confirmation point. So at the moment, is this just an expansion of this digestive trade, and we're going to fall back into neutral, or are we going to confirm and really start to ramp up and break out in crude oil? So you can see how by looking at the different market states and structures, you can get a better sense of how all the dynamics of the markets are working together. The JS Services Analytics are all about providing you with comprehensive market awareness. What I've done here is I've added the Euro stocks and the DAX, 30-year, crude oil, NASDAQ, and S&P. So if we have a focus on the S&P, what's going to happen next? Always going back to the fact focus. S&Ps are in a bear trend. The structure of that bear trend, we have sentiment above the market, and we have a break in structure today, and we're here. We're in a transitional mode. Are we transitioning into a digestive trade, or are we going to have a runner trade that we're going to really bust out and have an aggressive buy posture? Well, currently we're not running. So the market's telling us something. At this point, we're in a run stage, and it could just really accelerate. We could have more of an event day. The fact that we're back here, we're really making a decision. Do we have the energy to really bust out, or should we just anticipate that we're going to see more digestive action? So if we get a rally back up to the 57 level to fade that move, or a break back to 38 or down to the 28 level, is that going to give us a bounce in more of this kind of more digestive trade? What's the rest of what are the other markets doing? Well, the NASDAQ's holding strong, and it's holding above its upside pivot. The Euro stocks have come off, and that market broke out to the upside, attained its initial target, and now it's starting to come off underneath its R level. What's the DAX doing? That was the leader. It attained its 2 APMD targets, and now it's pulling back to its upside pivot. So this is just normal action there. So not, just everything's still in line with this upside breakout theme for the S&P. You have support for that. DAX, Euro stocks is showing you maybe this is over. We're going into digestion. We've got the interest rates are still depressed. So if that's the sell bonds, buy stocks, that symmetry is happening now. Crude oil has been a good leader today. So we've had the market is following a lot of the crude oil action, and so crude oil broke out above its upside pivot, but it failed to confirm the breakout, rejecting from the 43 level. So how that market reacts here? Does it stabilize and go? If the crude oil can't stabilize above 76, that's going to drop this market into more of a neutral state, and we could see kind of a digestive action between 43 and this 45.16 level. And so this non-interest in the crude oil, which may have been part of the spark to get things going in the equities, might be over, and that could just tell us that there's not much left of an expectation for us in the S&P today. So at this point, what do we know? We know the market is no longer in a bear trend. We know the market's in transition. Are we going to scale higher? We know that we're not. We've taken out that energy here with this break-in structure. Can we still transition higher? Yes, but it's going to be a different type of transition. Or are we going to settle back into a sideways trade? At the moment, we're still holding positive structure, so I've added our alert distance using the Sierra Charts application, and we can see how the market is kind of rotating around this variance, around this inflection point. But what do we know for a fact? We know the market confirmed an upside breakout, and we know for a fact that until the market goes below the directional at 1928.50, this positive momentum is in play. This upside breakout is in play. If it builds structure above this level, that's more aggressive positive action. Even above this 1957 may be more aggressive. Can we dip down to 38? Absolutely. Still underlying positive buy break bias because we're still in this theme. These themes have been negated. So is this theme going to play out? And this structure break now is below the directional. Not that we're risking all this. We don't need to. We can use, a metric like our alert distance. But this action is showing us, what is the value? What is the opportunity? So if we're accepting buy signals here, what's our minimum target? Well, our minimum target is 1957. And that would be a digestive target. So as we jump forward, we see the market did squeeze a little bit down to the lower end of that variance. But then, that was kind of gave it the energy it needed to make a push into the top of this variance. And so now, if we're in for, the market's always giving us tells, and what it's telling us now is that we are in potentially a digestive session, kind of a sideways, potentially non-event session. We had the earlier move to confirm the breakout, breaking structure. We're not able to really follow through on this trade. It's not negated, but the market's giving us tells that it may be more of a digestive trade. And so if the market does start to rotate lower, we would anticipate that this market is going to find some support down at 1938. Here we can see the nice confluence with the NASDAQ. So we had this same positive push here. The NASDAQ holding a little firmer, giving us another positive push into its CRX plus. And we're getting a little bit of a reaction there. Again, it's in the same state, same structure. We have same expectation, and we can use these markets to give us more awareness so we can anticipate the next reaction. And with the market topping out here, the sideways expectation, having to move back down to the upside pivot, if not back down to the CR plus. Jumping forward, we have the market attaining our half APMD, and it's time for another decision. So here at the moment, we're still in accepting buy signals. Fact focus, we're transitioning out of the bear trend. We're in that hedge strategy theme, and we're in that hedge strategy theme as long as we're above this UPR level. If we do transition lower, take out this alert distance on the downside, then we could shift into a short-term sell opportunity, anticipating a move down to 1938, if not 1928.50 in the S&P, or back down to this 2975, 4206.5 level in the NASDAQ. One thing for sure though, anything on the short side is a hot potato, because we are in that positive transitional hedge theme. So we like looking for buy signals over sell signals. The interest rate market is still weak, so the 30-year continues this negative breakout. So the 30 years in that neutral digestion, and we're in a transitional hedge theme here as well. This sell DP breakout strategy. And so here's the DP, and so we're in this sell DP breakout, and we're attaining one full APMD at our initial downside target. So we have that confluence going where we have negative momentum here, and the market is holding firm in the S&P. A lot of times interest rates make their move earlier, and so this is another good fact that we have this inverse relationship with the interest rates and the stock market going on right now, and this market is following through to the downside. So is this a tell that the stocks are going to fall through to the upside later? So here's crude oil. Crude oil hasn't confirmed anything yet. So it's working the structure really nicely today, but it did not confirm the upside breakout. Fell back into neutral, and now we have this kind of zone here from 46.43 to 45.16, rotating around the R level, where the market more likely is going to make a decision that it's going to bust out of this neutral zone to the upside, or we're just going to reject at the upside pivot, after potentially a retest here, and fall back into more of the neutral digestion. So the S&Ps are following along a little bit, and so the fact that the crude oil stabilized at this level when the S&P is here at the upside pivot, is this market going to give us a bounce? And if so, is that going to affect the S&P? And so if it doesn't affect the S&P, that's another good information that, hey, the S&Ps aren't watching crude oil anymore. And so you can kind of see clearly, based on the structure, the magnitude of potential moves. Is crude oil providing an influence? Are the interest rates providing an influence? Is the NASDAQ providing an influence for what's happening in the S&P? Another thing I want to point out when you're looking at confluences is how they can change. And so here you see the S&P is acting a little weaker than the NASDAQ. NASDAQ's holding stable here. S&P's pressing the lower end. NASDAQ's still holding stable. And then we have this rally where they both attain a half an APMD, and on the subsequent break, the S&P is stabilizing above the upside pivot R, and the NASDAQ is getting squeezed. And so here it flipped. The S&P took over control, and it was the leader, stabilizing above its upside pivot, and called this rally back up to the 1957 CRX Plus. So again, keeping with the fact focus, the market's performed to expectation, broke structure, we're in a hedge strategy theme, and the market continues to hold above the upside pivot. And as we move forward in time, we see that the market does follow through and attains a full average price map distance, attains our initial target at 1966.25. The NASDAQ did the same, so it followed through on its signal. So we can see how sticking with the strategy theme, having that awareness, all day long the market told you what it wanted to do. It broke out and broke structure, told you it wanted to be in a hedge theme, it gave you a corrective squeeze back, maintaining a hedge strategy theme, looking for that theme to follow through, and the market starts to stabilize and gives you multiple opportunities and starts to build positive structure and attains a full average price map distance target. So we've seen a market that started out in a bear trend and then shift into a transition. So this is a transitional session. So you have a classic textbook transitional session for a bear trend. This is the power of the method, where we identify the market state, the structure of that state, the strategy themes. We look at the market price action within the structure, and it identifies which strategy theme is dominant, and once that's identified, we can align our tactics to capture that opportunity. If you have any questions, please feel free to email me at info@jsservices.com. Thank you.